Ah, scalping. It sounds exciting, right? Quick profits, fast action. It pulls traders in with this promise of making money in just minutes. But here's the thing. If it's really that simple, why do most people who try it end up losing? Let's dive in and really uncover the strategy that the majority of traders get completely wrong.
Let's kick things off with a number that's, well, it's pretty shocking. According to a recent CBI report, Indian traders lost a massive amount of money in the derivatives market. And look, that's not just some statistic on a page, right? It's a huge warning sign. The dream of getting rich quick too often turns into a very, very expensive lesson.
So this brings us to the real million-dollar question, doesn't it? Why? What is it that separates that tiny fraction of traders who actually make money from the 95% who are consistently losing? The answer, it isn't some secret magic indicator. It's all about how they approach the market, especially with a technique like scalping.
So let's talk about it. Scalping. Is it really the express lane to financial freedom? Or is it more like a super dangerous game for anyone who isn't disciplined? As you're about to see, what people think it is and what it actually is, well, they're worlds apart.
Okay, first things first, let's make sure we're all on the same page. Scalping is all about grabbing tiny little price movements. Scalpers are in and out of the market in minutes, sometimes even seconds. They're not trying to hit home runs. They're aiming for these small, consistent little wins that hopefully, add up to something big over time.
Now, this next part is a massive mindset shift. We think of scalping as being fast, but mastering it, that is incredibly slow. It is not a lottery ticket, it's a super high-level skill. Seriously, think about it like watching Virat Kohli hit a perfect cover drive or Jasprit Bumrah bowl a crushing Yorker. It looks so effortless, but what you don't see are the thousands and thousands of hours of disciplined practice that went into it.
To really understand how to do this the right way, we first need to see what goes wrong for most people. So let's break down the most common mistakes that trap new traders.
And the biggest pitfall of them all is usually just overconfidence. Let me tell you a cautionary tale about a trader named Sachin Yadav that illustrates this perfectly. It's a real eye-opener. So Sachin starts trading and boom! In just 2 months, he makes a profit of 12 lakh rupees. I mean, for a lot of people, that's more than a whole year's salary. Can you just imagine the excitement? He must have felt completely invincible.
So, fueled by this incredible early success, he made a massive, life-changing decision. He quit his stable, well-paying job at Infosys to become a full-time trader. He was totally convinced he had cracked the code.
But the market, well, the market has a way of humbling absolutely everyone. Over the next 4 months, Sachin lost 20 lakh rupees. Not just his profits, but all of his personal savings too. Gone. His story is just such a powerful reminder that a little bit of early luck is no substitute for a real, disciplined strategy.
Okay, so having seen those dangers, how can we approach scalping in a way that's more structured, more professional? Let's build a simple, rule-based strategy together. Okay, so here's our toolkit. First up, the time frame. We're going to use a 3-minute chart. Why? Well, the 1-minute chart is usually way too noisy with false signals, while the 5-minute can be a little too slow. 3 minutes is often that perfect sweet spot. Next, we'll use 2 simple moving averages, or SMAs. Just think of the 22 SMA as our speed indicator and the 33 SMA as our confirmation indicator. And these numbers aren't random. They're based on about 1 to 1.5 months of trading days, so they give us a really solid view of the short-term trend.
Now, a toolkit is totally useless without instructions. And this is where most traders fail. They just don't have strict, non-negotiable rules for when to get in and when to get out. You have to define these rules before you ever place a trade. So, let's walk through the rules for a buy trade. First, the trend is your absolute best friend. Both the 22 and the 33 moving averages must be rising. Second, you wait for a pullback. You let the price come down to touch or get super close to those moving averages. Third, you need a signal. A green, bullish candle has to form right at that support level. And only then do you act. The entry is a buy order just above the high of that candle, with your protective stop loss placed just below its low.
And here's what that looks like in the real world. You see? Both moving averages are pointing up. The price pulls back to that support zone, and a nice, clear, bullish candle appears. The entry gets triggered above its high, and the trade moves in our favor, hitting a target that was twice the amount we risked. This is the system working just like it's supposed to. Now, for a short trade, we just flip the whole thing upside down. It's the exact same logic. First, both moving averages have to be falling.
Second, we wait for the price to rally up and find resistance near them. Third, a red bearish candle has to form. Your entry is a short order just below the low of that candle, with a stop loss placed right above its high. It's a perfect mirror image. Okay, now this. This is probably the most important example in this whole thing, because not every trade will be a winner. So here, a valid buy signal came up, and the trade was taken exactly by the rules. But then the market just turned around. The crucial part is that the stop loss was already in place. It got triggered, and it closed the position for a small, acceptable loss. This is not a failure of the strategy. This is the system successfully protecting your capital.
And that brings us to the single most important concept in trading. I mean, this is the one thing that separates professionals from amateurs. Let's talk about your biggest safety shield, risk management.
Here it is, the golden rule. You never risk more than 0.5%, 0.5% of your total trading capital on any single trade. So what does that mean? If you have a 1 lakh rupee account, your maximum acceptable loss on one trade is just 500 rupees. That's it. This one rule ensures that no single loss or even a string of losses can ever wipe you out. It is the key to your survival in this game.
And this quote just nails the professional mindset perfectly. You got to stop thinking about this week or this month. You have to start building a multi-decade mindset. You aren't just placing a few trades, you are building a career that could last for the next 40 years. And when you have that long-term perspective, taking small, calculated risks is the only thing that makes sense.
So, with the strategy and the risk model in place, let's wrap all this up with a few professional tips to help you actually put this into practice.
These are the habits that define a pro. First, avoid those impulsive decisions. If a setup doesn't meet every single one of your rules, you do not take the trade, period. Second, if the market is just moving sideways and the moving averages are flat, just stay out. Don't force trades that aren't there. Third, backtest this strategy, then practice with paper trading to build your confidence. And finally, if your capital is limited, stick to highly liquid stocks that tend to move a bit more cleanly.
And let's end on this one thought. It won't happen in the day, but one day it definitely will. Look, this journey is going to have learning curves and it's going to have setbacks. But with discipline, a proven system, and a long-term mindset, success is actually possible. The key isn't to be perfect on day one, but just to be persistent every single day.